Sentinelone just reported their earnings and they were good. The stock went up in double digits and came back down. It's currently trading at about $16.8 with a market cap of about $4.7 billion. About a week ago, the stock went up because of the rumor that Sentinelone is up for sale. But today, the CEO said it's not up for sale and they're going to focus on their individual path. And that's one of the reasons the stock sold off even though it went up double digits today. In any case, the stock will do what it's going to do, but we have to focus on fundamentals as investors. In the most recent quarter, they made about $149 million, and that represents an increase of 46% year over year. The expectation was close to $140 million, so they beat that revenue expectation. The gross margin actually increased to 70% from 65%. Sentinelone has about $1.1 billion of cash equivalents, and short-term investments. And this $1 billion is almost 20% of their market cap. So that's actually a good position to be in. Let's look at the forward guidance. They raised the guidance to $605 million. Previously, they had a guidance at $590 to $600 million. Now they're saying they can get to $605 million. So that's actually increase in guidance. And this $605 million represents 43% year over year growth, which is impressive. Let's quickly look at their income statement. As you can see on the screen, in the most recent quarter, they made about $149 million of revenue. And the gross profit is about $104 million. So that's about 70% gross margin, which is a healthy gross margin. Gross profit is $104 million and operating expenses are $205 million. So obviously they'll make an operating loss, and that's about $100 million. And they also have interest income. So the net loss is about $89 million. This company has cash equivalents, and short-term investments of about $1.1 billion, right? So compared to that, this loss is not too significant. But the good news is Sentinelone is reducing its loss and increasing its revenue. With respect to the number of outstanding shares, Sentinelone is diluting the shareholders significantly, as you can see on the screen. In the most recent quarter, they are reporting 293 million outstanding shares. And a year ago, they had 277 million. So that's about 5.7% dilution. I'm going to consider that in the valuation. And finally, the stock-based compensation in the most recent quarter is about $52 million. So that's about 30% of their total revenue, which is not a good figure. But stock-based compensation is definitely high, but compared to a year ago, when they were handing out 40% of the total revenue, this is heading in the right direction. Before I show you the valuation, this is not financial advice. I'm not a financial advisor. I'm not qualified to give financial advice. And in full disclosure, I do own close to 200 shares of Sentinelone at a cost base of about $13.68. Now let me show you the valuation. This is the same screenshot that I've shown in my previous videos. In 2023, they're expected to make $600 million of revenue. And I'm estimating a growth rate of 35% year over year. Remember that in the most recent year, they're saying they can get to 44% year over year growth, right? So as the company gets bigger and bigger, it's going to grow slower, but Sentinelone is still a small company. So in my opinion, they can maintain 35% year over year growth on an average. With that, they will make close to $2 billion of revenue in 2027. The gross margin, I've assumed, is actually an older number, 68% gross margin, but now they are close to 70%, right? So the net profit margin would be close to 25%, but I'm still keeping it 23%. With that, the net income in 2027 would be about $400 million. I'm assigning a multiple of 27.5 for a company that's growing at 35% year over year and 25% net profit margin. I can easily assign a 30 multiple, but I'm assigning 27.5. I just want to keep it a little bit conservative. With that, the market cap in 2027 would be about $12 billion. With respect to the number of outstanding shares, currently they have close to 290 million, right? And they diluted us by about 5.7% in the most recent year. But the stock-based compensation is coming down, right? And in the coming years, it'll be further less, but I'm still assuming 5% dilution year over year, which I think is conservative. They should dilute us less, but I'm just going to keep it conservative. With that, they will have 368 million outstanding shares in 2027. When I divide the $12 billion of market cap with 368 million outstanding shares, I get a stock price of about $34. Currently, they are close to $16, right? So that's more than 100% gain in 5 years, which is very attractive. And I'm being conservative with respect to multiples as well as the dilution, right? So the return would be much higher if they execute better. And I also want to note that they have close to $1.1 billion of cash equivalents, and short-term investments. So that money is owned by us investors. So if I also consider that in the stock price, that would add another $3 to $4 to this stock price. So we're looking at an easy 100% plus gain in the coming 5 years. So I continue to feel that $16 is a good price to be in Sentinel-1. My cost basis is close to $13.68, so I will not be adding. I'm just keeping this position of 200 shares intact. I'm not going to sell. And finally, I'm actually feeling good that the company has shed that idea of being on sale. Instead, they want to focus on their individual growth, and that's what, as a shareholder, I expect. I want to triple my money with this stock in the coming 3 to 4 years. In conclusion, the earnings were good. I will continue to hold on to Sentinel-1 stock. I will not be adding. If I add to this stock, I'm going to post on YouTube community. Thank you so much for watching. Let me know your thoughts in the comments.